It starts quietly, almost imperceptibly. A series of red numbers flicker across screens on Wall Street. Traders glance at their monitors with mounting unease, coffee cups forgotten mid-sip. By the time most Americans check their investment apps that morning, the headlines have already gone viral. Stock market crashes 50% overnight. Trillions of dollars have disappeared from the financial system. Panic is both immediate and invisible. A slow wave of disbelief that spreads from boardrooms to living rooms, from hedge funds to kitchen tables. In the United States, the initial shock is paralyzing. Investors awake to find retirement accounts halved, savings diminished, and portfolios that once symbolized security now reduced to fractions of their former value. The financial elite, those who once wielded immense power through equities and derivatives, scramble to reassess risk. Hedge funds attempt desperate maneuvers to limit losses, only to realize that leverage, once a tool of profit, has become a chain of destruction. Margin calls explode, forcing asset sales that deepen the market's collapse. The dominoes begin to fall. Banks, tightly entwined with the stock market, confront their own existential threats. Investment portfolios shrink, loans lose their collateral value, and liquidity freezes. The Federal Reserve steps in, but its usual arsenal of tools, lowering interest rates, injecting capital, quantitative easing, can barely keep pace with the speed and severity of the crisis. Unlike typical corrections, a 50% drop is not a mere adjustment. It is a structural shock. Confidence, the invisible currency that fuels markets, evaporates faster than any cash infusion could replace it. Households experience the immediate sting. Millions realize that the value of their homes, tied indirectly to equity markets through construction, demand, and financing, begins to wobble. Retirement accounts, often a family's largest financial asset, lose half their worth overnight. Middle-class Americans who relied on decades of growth in equities and mutual funds feel the rug pulled from under them. Consumer confidence plunges. Spending contracts sharply. The economy, already delicate, teeters on the edge of contraction. Corporations, once thriving on the optimism of rising stock prices, face sudden liquidity crises. Access to capital dries up as investors retreat. Companies with high debt-to-equity ratios confront defaults. Those dependent on expansion financed through equity sales can no longer sustain operations. Layoffs ripple across industries, starting with finance, technology, and consumer discretionary sectors, then cascading into manufacturing, logistics, and services. The unemployment rate spikes as firms scramble to survive, and the stock market's initial shock translates into real-world hardship for tens of millions of Americans. But the shock does not remain confined to U.S. borders. Global markets, intertwined more tightly than ever, react almost instantaneously. London, Tokyo, Frankfurt, and Hong Kong wake to see their indices plummet in sympathy. International investors holding U.S. equities in dollars reassess their exposure. Emerging markets, often reliant on capital inflows from developed nations, face sudden withdrawal of funds. Stock markets across Asia, Europe, and Latin America lose value rapidly as panic spreads. Trillions more vanish globally, and a worldwide recession becomes almost inevitable. Commodity markets surge with volatility. Gold, long considered a safe haven, spikes as investors flee equities. Oil prices swing wildly, influenced by anticipated drops in consumption and corporate stability. Agricultural commodities experience shocks as supply chains strain under credit freezes and market uncertainty. Even currencies feel the tremor. The dollar initially surges as a flight to safety asset, only to later fluctuate wildly as the U.S. economy weakens, trade slows, and confidence in financial institutions falters. Governments scramble to respond. In Washington, emergency meetings convene at the highest levels. Policymakers debate the merits of stimulus versus austerity, fearing both inflation and deflation in a single breath. Congress considers emergency measures to stabilize banks and markets, but the speed of the crash outpaces legislative action. Central banks around the world coordinate interventions, yet coordination is only partially effective. The markets move faster than policy. Global trade contracts as multinational corporations delay investment, halt hiring, and reassess supply chains. The human cost is immediate and stark. Millions of workers see their 401ks vanish, retirement plans evaporate, and investments in educational savings reduce to shadows of their former value. Consumer spending, the engine of the U.S. economy, plunges, forcing further layoffs. Confidence, once a bedrock of economic stability, collapses. Ordinary families confront impossible choices: delay home purchases, postpone education, reduce consumption. Anxiety permeates society, and the social fabric frays under the weight of economic stress. Small businesses, long reliant on credit and local demand, find themselves at risk of closure. With banks tightening lending and consumer purchasing power down, many cannot sustain operations. This leads to a feedback loop. Layoffs depress demand further, which leads to more business failures. Cities with high concentrations of financial and service industries feel the greatest impact, yet no region is entirely immune. Rural areas, often buffered from direct market exposure, nonetheless experience secondary effects as consumer demand falls and credit tightens. Corporate bankruptcies surge. Iconic companies, once symbols of American innovation and prosperity, face restructuring or liquidation. Industries heavily leveraged or dependent on equity financing, technology, real estate, airlines, retail, are especially vulnerable. Defaults on corporate debt ripple through the financial system, causing further stress on banks and credit markets. Bonds lose value, insurance firms confront payouts, and investment funds collapse. Confidence in institutional stability declines, threatening the foundation of the entire capitalist system. Internationally, geopolitical tensions rise. Nations dependent on U.S. investment or trade face sudden capital shortages. Emerging economies see their currencies weaken, interest rates spike, and debt repayments strain national budgets. Some countries experience protests and unrest as unemployment and inflation worsen simultaneously. Trade agreements and cross-border investments are renegotiated or frozen. The globalized supply chain, designed for efficiency, proves fragile under the shock, exposing vulnerabilities in food, medicine, and energy distribution. Financial contagion spreads to the banking sector worldwide. European and Asian banks exposed to U.S. equities and derivatives report enormous losses. Interconnected financial obligations threaten solvency in institutions once considered untouchable. Governments and central banks intervene with emergency measures, yet the psychological impact of market collapse undermines trust in traditional economic systems. Bailouts are proposed, but moral hazard debates slow their implementation. Citizens protest, angry at perceived favoritism toward corporations over households. Central banks experiment with unconventional measures. Interest rates are slashed to near zero. Liquidity injections attempt to stabilize banks and markets. Governments deploy fiscal stimulus packages, but with public debt already high, the resources available are limited. The velocity of money slows as uncertainty dominates decision-making. Businesses delay investment, consumers reduce spending, and the economy remains in a precarious limbo. Confidence, not capital, becomes the scarcest commodity. The psychological impact on investors is profound. Individual and institutional behavior changes dramatically. Risk appetite collapses. Stock trading volumes spike initially as panic sales dominate, then fall sharply as uncertainty paralyzes market participation. Wealth inequality widens, as those who liquidated early or held cash avoid the worst losses, while others see fortunes erased. Generational wealth, accumulated over decades through equity growth, is decimated. The cultural perception of the stock market, once a symbol of opportunity and growth, is forever altered. Housing markets face secondary shocks. With equities down and consumer confidence shattered, demand for homes drops. Construction slows. Property values in speculative markets fall sharply. Mortgage defaults rise as unemployment spikes, creating stress in the banking sector. Homeowners previously buffered by diversified portfolios find their net worth slashed. Real estate, often viewed as a safer alternative to stocks, is dragged down indirectly by broader economic contraction. The ripple effects on innovation and technology are severe. Startups reliant on venture capital funding see access to capital evaporate. Research and development projects are delayed or canceled. Technological growth, once fueled by investment optimism, slows dramatically. Corporations prioritize survival over innovation. Breakthroughs in medicine, energy, and infrastructure are postponed, illustrating the non-linear impact of financial collapses on human progress. Political consequences are inevitable. Public outrage over lost wealth, job insecurity, and perceived government inaction leads to unrest and polarization. Populist movements gain momentum, blaming elites, financial institutions, or international competitors for economic collapse. Policymakers are forced into reactive measures, often prioritizing short-term stabilization over long-term reform. Social trust erodes as citizens question both market mechanisms and government competence. Internationally, alliances shift. Countries that weather the storm better, often those with diversified economies, robust reserves, or less reliance on U.S. capital, gain influence. Nations heavily dependent on foreign investment or commodity exports experience hardship, creating tension in trade and diplomacy. Global cooperation is tested as nations prioritize domestic stabilization over collective recovery. Geopolitical risk rises, with some states exploiting financial turmoil to pursue strategic advantages. In the long term, the crash reshapes economic norms. Regulators implement stricter oversight of financial markets, leverage, and derivatives. Risk management practices evolve. Central banks adopt new frameworks for crisis prevention. Investors become more cautious, emphasizing resilience over short-term profit. Economies adapt to slower growth rates and higher uncertainty, balancing risk and stability in ways previously unseen. Yet amidst the turmoil, opportunities emerge. Businesses capable of surviving the crash gain market share. Investors who act decisively can capitalize on undervalued assets. Governments and institutions that implement effective stabilization measures earn credibility. Over time, confidence gradually returns, albeit tempered by a new awareness of fragility in global financial systems. The world is more cautious, more resilient, but the lessons are etched in memory. A 50% stock market drop is not just a number. It is a societal event, a generational shock, a redefinition of wealth, confidence, and global interdependence. It reminds humanity that prosperity is fragile, markets are psychological as much as mathematical, and in an interconnected world, no economy is an island. The day the stock market fell by half will be remembered as the day the global financial system paused, reevaluated, and learned the cost of overconfidence. From Wall Street to Shanghai, from small businesses to multinational corporations, the ripple effects of this single event would echo for decades, shaping policy, culture, and human behavior long after the numbers themselves begin to stabilize. The lesson is stark. Wealth is ephemeral, markets are fragile, and the only certainty in finance is uncertainty itself.